Okay, so now in this video we're going to explain how to do the weighted cost average cost flow method with perpetual inventory. In the first two videos that I explained cost flow methods, the first one I explained the FIFO method. In the second one I explained the LIFO method, and this is the final method besides the specific cost identification, which I didn't do a problem for, but I also explained in the first video. And so I've explained pretty much 3 out of the 4. And so the fourth one is the weighted average cost method. And what I didn't delete this, I just have it. I didn't sort of hide my work like I usually do, because I don't think it's necessary at this point. We've already done 2 similar problems. But this problem, you can find it on page 308 and 309 in your book, and it is the problem 6-3-6-3A from the problem series A. And what they present us is with a sort of a sheet like this one here. Let me show you this. Let's see if I could. Okay, they give us this information here, and we're supposed to calculate cost of merchandise sold using FIFO, LIFO, and weighted average, right? So as I've done before, I sort of transformed this data into a data that I can use without causing the least errors possible. And so with FIFO, I sort of ended up with something like this, and I showed you how I slowly started to build this and getting my entries. LIFO was something very similar, but for weighted average, I'm going to do it just slightly different, and there's no scientific method to what I'm doing here. I just come up with this intuitively, whatever works for me. So it's a little bit of art, half science. Like I said in various other videos, you use the methodology that you feel more comfortable with. If the book has a different format of how to come up with the numbers, that's fine, as long as you get the right numbers, okay? So why do I do it slightly different? Well, because the weighted average cost method, you're really going to get your cost of merchandise sold from one line item. But that line item is going to be a weighted average cost of the previous layers of inventory, right? So what I did was I created 3 columns to the side, to the right hand side of my information. This is the information that was given, with some added rows in them, but this is pretty much the information that was given. There's nothing added to it. So whatever I'm going to add, I'm going to add to the side. And the reason for that, you'll notice, is because I'm going to do a weighted average cost based on the other layers of inventory. So when I do my first layer of inventory, is what my starting inventory was, $2,500 at $60. Now this is going to be my cumulative amount here, where I accumulate anything that's prior, that inventory plus what was purchased prior. So this one has nothing purchased prior to it, right? So the cumulative total is going to be 2,500. The total value is going to be 150, and so the weighted average cost is going to be 60, which matches what we have here, right? There's not going to be any change because it's only one layer of inventory. But now I go to my second one, and now I'm going to do a cumulative. So what does this 10,000 represent? Well, I'm adding these 2 up. So this is what I have in my inventory, a total of 10,000. I know one layer was for 150 and one layer was for 110, so that adds to 660,000, right? So that this is how I do this. I simply, well, I should have added these 2 here. Or I could just add it from my previous and this one, so doesn't really matter. Bottom line is I have 660, and then here I simply calculate what my weighted average price is going to be based on total value divided by cumulative units. And my weighted average is 66, which is somewhere in between the 60 and the 68. So that makes sense. For those, you should know weighted averages by now. Why is it closer to the 68 than the 60? Well, because this one carries a higher weight, right? This one has 7,500 units. So the weight that it's going to carry is 75%. This one has 2,500 units, so it'll carry a weight of 25%. And so the weighted average is going to be closer to the 68 than it is to the 60. And that's just math. I shouldn't be explaining that at this point. You should understand that type of math by now. Okay, so then we look at the sale. So this is the sale. We know that the sale was $3,750 at 120. So accounts receivable and sales revenue is going to be $450,000, right? So that's what we have here. And so let's just do I'm not gonna white it out or anything for now. I think you guys can follow me quite easily. So that's this entry here, right? Accounts receivable 450 and sales revenue 450. So now we have to figure out how I came up with this entry over here, right? So I'm just gonna calculate my cost of merchandise sold right next to it. I know I sold 3,750, right? Now I'm going to get my weighted average, which I already calculated on top. That was 66. I bring it down here. 66 times 3,750 is 247,500, right? So that's going to be my cost of merchandise sold, which is calculated using a weighted average of the previous layers of inventory. So now I have all my information. This gives me my sales. This gives me my cost of merchandise sold right here. And here we have the full accounting entry. Okay, so we continue with the problem, and the next sale is going to be fairly easy, right? Because there's no other purchases. So all we're going to do is we're going to take this, my last calculation, and we're going to bring it down minus the 6,200 and minus the 3,750 that we sold. Now that doesn't change the weighted average cost. We roll over the weighted average cost at 66. And just like in the previous problems, at this point, this becomes part of the history. We do not worry about this anymore. Now we're going to be looking at the problem from here down, and and it leads to less confusion when you don't have to constantly be looking back. So remaining inventory was 6,250. We had another sale of 1,250. So what's the cost that I'm going to apply? Well, the cost that I'm going to apply is the 66 that we already calculated, right? So there's no need to calculate another weighted average here because there was no additional purchases, no additions to the layers of inventory. So we know that excuse me we know that the sale was 150,000 and we know that the that cost of merchandise sold was at 66 times 1,250 comes out to 82,500. So we have our two major figures here, and it's very easy to create the accounting entry, right? Sales revenue 150, accounts receivable 150, cost of merchandise sold. From here, by now you should have this by heart. I've repeated it at least 20 times. Cost of merchandise sold 82,500, and inventory goes down by 82,500. Okay, so we have another sale here of 500. Again, you roll this inventory down. You had 6,250, weighted average cost of 66. You sold 1,250, so now you have 5,000 remaining, weighted average cost of 66 for a total value of 330,000. Did I explain this one? No. This one, February 5, another 500 units sold at 120, so we have $60,000 sold. We know that's going to be the sales revenue. The cost of merchandise sold, we take it from the remaining inventory that was rolled down, and that would be from this layer here. So we sold 500 at 66 for 33,000, right? And so our two key figures here are the 33,000 cost of merchandise sold, 60,000 for sales revenue, and we come down here and we see that the entry is this one here. And as you can see, we're using the two major calculations. Well, really one major calculation. This one is given by the problem. So now we have a purchase. So now we roll over the 5,000. We sold 500. We rolled it down. Now we have 4,500 remaining at 66. And this weighted average of 66 was the same one that we calculated all up here. We haven't changed it because we haven't made any more purchases. We haven't made any more addition to the layers. But finally, we make another addition to a layer, which is important if I'm going to teach you how to do this. So this is going to be 18,000 at 70 for a total of 1,260,000. So notice how here is 18,000, here we have 22,000. Why? Because this is going to be cumulative, because I want to have a weighted average, so I have to do it cumulative, right? I have 4,500 plus 18,000 is 22,500. This one was valued at 297,000. That was already rolled down, right? This one, they told me, is valued at let's see, the purchase is going to be 1,260. So if I take the 297 and I add the 1,260, I will get 1,005,057, right? So as you can see here, this plus this, so that's going to be my total value, right? The value that I had prior plus the value that I purchased now is the total value of the 22,000. And then you can calculate your weighted average, your new weighted average cost, which is 1,557,000 divided by 22,500 units, and that's going to be $69. Is it rounded? No, it's $69.20, right? So you're seeing the numbers rounded here, but I obviously want you to use the cents as well. Let me just leave it like that because I started off like that. So now this is the new weighted average for your inventory. So now that's what you're going to use going forward until you purchase some more. So now you have a sale. And remember, I don't really show the entries for purchases over here, but I do add them to the T accounts. So 1,260,000, as you can see, I added it to my inventory here, and so all that is an increase in inventory and an increase in accounts payable if it's purchased on credit, right? So if you sell 9,000, as it says here, at $125, you'll have sales revenue of 1,125,000. And your cost of merchandise sold for that 9,000, now you're going to apply your new weighted average cost. Okay? Do not confuse this with FIFO or LIFO. These are not two layers anymore. This is a cumulative rolling average on this side. So all you need to look at is always at this, which is a weighted average of this and this. Okay? So 9,000 units sold at $69.20. We don't see the 20 cents there, but it's $69.20 is going to give me a total cost of merchandise sold of $622,800. So with the two main data points that you need for your entry, 1,125,000 and $622,800, we go ahead and we do the entry over here. We journalize it. Remember, this is the journalizing process, and then we go ahead and we post it to the GL. So there's that entry, and we're going to continue with the problem. I'm not going to explain this entry. I've explained it so many times already. Okay, so now we have another sale. Well, what do we do next? Well, we roll this down just to make sure that we keep everything on track. You know, every good accountant has to make sure they have a system that will help them to prevent as many errors as possible. So 22,000 minus 9,000 is 13,500 at the same weighted average price, 69.20, is going to give me inventory of 934,200, and this is my new weighted average that I'm going to use for my next sale. And my next sale is going to be 8,500 units, sales revenue of 1,062,000. I sold that 8,500 units at $69.20 for a total cost of merchandise sold of $588.20. And so my entries here, you're gonna see them down here. Let's scroll this up. Yeah, okay, so you're gonna see the February 28 entries are all the way down here. You can see they don't match as far as, I don't line them up because this one here I put the information to the side. So February 28 entry is going to be over here, and as you can see, those numbers match, the 1,062,500 and the 588,200. Okay, and we do the same. We roll down the weighted average inventory. 22,500 minus 9,000 is 13,500. At a weighted average unit cost of 69.20 gives me a total inventory of 934,200. I booked my next sale. Well, I'm sorry. Wrong line. So I was over here, right? Remaining inventory was 13,500 minus 8,500. Now I have remaining inventory of 5,000 at 69.20, right? So now we are going to work from here down. I do a purchase. So my purchase, my individual purchase was given to me, remember, and this is going to be my cumulative inventory so that I can get a weighted average. So I have 5,000 units at 69.20. Remember, that comes from up here, this minus this, 5,000 units at 69.20. I purchased 15,000 units at 71.60. So 5,000 plus 15,000 means that I now have 20,000 units, right? 346,000 units, dollars in units, plus $1,074,000 in dollars in units is going to give you a total of 1,420,000. Again, as you can see, that's this plus this, and so my weighted average cost is 71. Let's see if there's any cents there. No, this time we're at 71 even. Okay, so that's my new weighted average cost, and that'll be applied to my next sale, which we have here. Sale is 1,250,000. We apply for 10,000 units. We apply a cost of $71 to those 10,000 units to come up with a cost of merchandise sold of 710,000 units. We'll go ahead and post the entry somewhere around here. That's the sale of March 14, so it's this one over here. And we go ahead and we roll down our remaining inventory. We had 20,000, we sold 10,000, so we have 10,000 remaining, and we simply bring the $71 down because we're going to keep that weighted average cost with the remaining inventory, and that's going to give me remaining inventory of $710,000 in value, right? We have another purchase here of 12,500. Sorry, see, that's where the confusion may lead. The purchase was for 2,500 units at $72. So we roll it down on a cumulative basis over here. 10,000 plus 2,500 gives me a total inventory weighted out of 12,500, and I had $710,000 worth of inventory. I purchased $180,000 for $890, and my new weighted average cost is going to be $71.20. And that I will apply to my next and final sale, which is going to be 8,750 units. I obtained $1,093,750 in sales revenue. I sold 8,750 units at $71.20 for a cost of merchandise sold of $623,000. And I go ahead and post those entries. Those entries are all the way down here. Okay. So then I roll this forward. 12,500 units at $71.20 minus 8,750 that I sold is going to give me remaining inventory of 3,750 units at $720. If I multiply 7120, sorry, not 720, 7120 times 3,750, my remaining and final inventory is going to be $267,000. Okay, so is that what I get when I post everything into the inventory account? Yes, these are all the I transfer all these over here, including the purchases, which I don't show here, and ending inventory is going to be $267,000. Cost of merchandise sold is going to be $2,907,000, and accounts receivable and sales is $5,191,250. Now you'll notice that these two have the same figures for all three cost flow methods, because the sales revenue is not going to change regardless of the cost flow method that you use. So you should always have the exact same number there, right? What's going to change is how you cost your merchandise. If you change how you cost your merchandise, then obviously that's going to affect your ending inventory. Now, because prices are increasing here, if you use the FIFO method, then you are going to be costing your merchandise at a lower price, because you're using the first unit, the first layer, which tends to be lower prices, right? So FIFO should have the lowest cost of merchandise sold under this scenario, under increasing prices. And let's take a look. We had 2,904,000 versus FIFO 2,939, and weighted average cost is 2,907,000. So FIFO did indeed give us the lowest price, right? Lowest cost of merchandise sold, sorry. LIFO should give you the highest, because you're using the latest layer, which tends to be at a higher cost under an inflated scenario, right? Inflation. So as you can see, 2,939 is indeed the highest cost of merchandise sold, and the weighted average is going to fall somewhere in between. Okay, so those are the three, well, there's 4 cost flow methods, and so you know, it's important that you understand how they're done. For the test, I doubt very much that I'll give you something this long to do. But I will ask questions to test if you understand the methodology and the reasoning behind each one of them. Okay? Thank you. I hope this helped.